Welcome to the Liquidity Event, a show about all things personal finance with a laser focus on taxes, financial independence, and equity compensation. Hosted by AJ and Shane of Brooklyn FI, each episode will focus on a personal finance topic, some driven by news headlines and sometimes driven by listener questions. And sometimes you'll just get two money nerds rambling about what they think is interesting. Just a quick note before we get started, this podcast is for informational purposes only and should not be considered tax or investment advice.
Hello and welcome to the Liquidity Event. We are your hosts, AJ.
And I'm John, filling in for Shane this week.
And this is episode 139, recorded on March 11th, airing on March 14th. A quick reminder to you listeners, we will answer your questions live on the pod if you leave us a message. You can disguise your voice. Use a fake name if you're shy. That link is memo.fm/the liquidity event. Today on the show, we have a very special guest, Christopher Karachale. Did I get that right?
Yeah, very good.
Yes, nailed it. Nailed it. I nailed the pronunciation of your name, just like you have nailed QSBS, Qualified Small Business Stock. You are a partner at the California-based law firm Hanson Bridget. You know so much about this fantastic tax loophole, and John and I are excited to grill you today. How are you doing, Christopher? Welcome to the Liquidity Event.
I'm excellent. I'm super happy to be here. As I said, though, before we started, if I had a big I feel like I'm not legitimate because I don't have that big microphone.
Well, you sound great. You got a face for radio, so everything's going great.
My wife does the same thing.
She tells me that before every recording, Christopher. So, but I still make it on when Shane's out of the country and doesn't have internet access. That's the prerequisite.
Oh, yeah, we got to pour one out for Shane. Shane is in Japan, living his best life. We love that for him. An entrepreneur who started a tax firm 10 years ago is now out of the country on March 11th because he has successfully delegated preparation and filing of our 600 tax returns here at Brooklyn FI. So we love that for him. And Shane, we hope you're having a great time in Japan. But today, QSBS. So Christopher, what is QSBS? What are we talking about today?
So QSBS, Qualified Small Business Stock, is a provision in the Internal Revenue Code that says if you get shares of a domestic C corporation and hold those shares for 5 years, and the domestic C corporation meets certain requirements, it's a qualified trade or business. When you sell those shares after 5 years, you can exclude the greater of 10 million or 10 times your basis. So no tax on 10 million, sometimes more, right? People do planning in with QSBS, so we'll see founders. It's normally tech companies who sell 10, 30, $50 million of stock, and provided the requirements are met, they can pay zero federal income tax. You know, in New York, you guys, I live in Manhattan, I pay zero Fed, zero state, zero local tax on sale of QSBS.
Yeah, and I think that gets lost on folks because, right, exclusion is the best thing you can get from an income tax perspective. It doesn't even show up on your return, right? It's not there. It's not a line item on Form 1040, which is a great deal. And this has been around for quite a while. There have been a few changes to QSBS to Section 1202. Walk us through, Christopher, you've been practicing this for quite some time. How did it even come around? How did we get something in the tax code that's $10 million tax-free?
Yeah. It's a super interesting story, right? Okay, so QSBS, most people think like QSBS has been around for like 3 years, right? It hasn't, right? QSBS came into the code in 1992. So it was there.
That's before you were born, John, right?
That's the year I was born. Me and QSBS, the two greatest.
The greatest $10 million add-backs to my life.
Yeah. You should put that in your signature block. Born the same year as QSBS.
As QSBS, yeah, exactly. I like that.
Okay. So the point of the story is QSBS in 1992 came into the code, but at that time it was just a 50% exclusion, right? And in fact, it wasn't really 50%. There's like an AMT, you could exclude half, but then you had an AMT add back. So, and at that time, like capital gains rates were 15% or 20%. The savings was like de minimis. It really wasn't.
Because you're paying 28% AMT on half of it instead of 15%, right?
Exactly,
okay.
Right? So that, like, I think the effective rate for shares that you got at that point is like 16.8%, right? You just like the savings isn't, at least at a 20% tax rate at that time, wasn't all that great. In 2009, the exclusion went to 75%, And then 2010, under the Obama administration,
Woo, woo.
right?
Yeah.
The exclusion went to 100%. So it's interesting. Like people think, oh, well, QSBS is a giveaway. I don't know. Maybe it's not important, or maybe politics is inappropriate. But it was like it's definitely under the Democrats that this came in at 100%, right?
Yeah.
So it's kind of interesting. So September, if you got your shares on or after September 28, 2010, and held them for 5 years, then you get that 100% exclusion. So it was in the fall of 2015, right? That's 5 years after the change that people were like, sort of, I remember in San Francisco having lunch with some CPAs and they were like, is it really like zero? Right?
Well, it's crazy. It's actually zero. And it's interesting that we started at 50 and got to zero so quickly.
Yeah.
Through different administrations too.
That's right.
And I'm assuming that, legislative intent is always a tricky thing to figure out, Christopher, but I'm assuming 2009, 2010, the economy's not doing great. They're trying to incentivize people to invest in these early stage startup tech company. That was the whole impetus behind this, I'm guessing.
Yep. And that, in fact, it goes back. There's nothing in 2010. I think they just wanted to increase this, but it all goes in 1990. The legislative history from 92, 93 is clear. It says, we want to give this tax benefit to people who invest in startups because startups fail, right? So the point is, if you get on board and they make the moonshot and they get it, right, you get the QSBS, you get that exclusion.
And so, I think it's funny because if you think back, this is before the tech boom. This is before the .com bubble. This is before this kind of land of milk and honey in the U.S. stock market, where everybody's making money and there's lots of dry powder. And if you got a cool tech idea, and I think we're kind of been back at that a little bit. 2022 wasn't the year, but right now it feels a little bit better for it. I'm gonna jinx us, and we're gonna fall into a recession here in 2 months now for saying that. But there has been no legislative changes to it since 2010 in terms of this. Nothing. Correct?
Yep. Absolutely. Right. The statute still is where we were in 2010. There's been more guidance about what is a qualified trader business. There's really no good case law. There's a couple of cases, one other that came out recently. But what's interesting, I think, John, is that, to your point, right? QSBS is this huge potential benefit now, and we have relative to the potential benefit, we have little guidance about how it should work. There's lots of open questions. The reason I have a job is that so much about 1202 and 1045 in the rules is gray. So we're trying to interpret the statute using analogous provisions. But it's interesting. Now we're almost 10 years in, right? You figure when we get to September 2025, we'll be 10 years into the exclusion. And I still think
we should throw a party. I'm going to throw a party.
Would it be like a bat mitzvah for QSBS or something here? Quinceañera. I think we're onto something here.
I think we're going to have that party, right? At Brooklyn Fi, at Brooklyn Fi.
Oh, yeah, always. So you mentioned a few qualifications, right? This isn't just any company. There's a checklist of things that your company has to hit in order to, we got to hit that 5-year holding period. I know there's something about having less than $50 million in assets. Just walk us through, you said this is kind of unknown. It's still not fully utilized. What are some things that founders or early employees should be looking out for or asking about their company to make sure that it qualifies?
Yeah. I mean, I think the way to kind of break it up to think it through is the company has to meet certain requirements and the shareholder has to meet certain requirements, right? So me as a shareholder, I have to get the shares of the company directly from the company, right? This is the original issuance. So I got to get the shares in exchange for cash, property, or sweat equity, not stock, which means I got to buy it. But let's say John gets the shares directly and then I buy his shares. That's not QSBS, right? I got to get the shares directly, right? You mentioned this, Jane, that you got to get it when it's less than 50 million, right? And that's not value. That's 50 million aggregate gross assets.
Okay.
So it's really has the company raised more than $50 million
in the bank? You got to have it in the bank. It's not your valuation. It's not your fair market value. It's not your 409A. It's just the cash you have on hand and any other assets or value property, not IP or anything like that.
That's right. And so, the founders clearly meet that criteria. And what's important is that it's not like that's a cutoff, right? It's not like the shares aren't QSBS. It's merely like the ceiling to say you have to get in before it gets to 50 million, right? And so Like the founders always satisfy that because they're like the first guys in.
Yeah.
Most of the early employees who exercise their ISOs or their NSOs, so they get it. And then the VCs, they get it too, right? So they come in the Series Seed or the A round or the B round. Sometimes if you do a big B round, may take you over. By the time you get to the C round, that's not going to do it, right? So you got to get the shares at original issuance. You got to get them before 50 million. Again, this is from the shareholder perspective, right? There's a rule that says there can't be redemptions. Like, in other words, if the company is buying back shares around the same time as you're buying shares, you got to be careful, because if the company buys back enough shares, it prevents the company from issuing QSBS at or around that same time. There was this rule because Congress was concerned that, like, people get QSBS and then have the company buy it back and exclude, and then get more and then buy it back. So there's
it's almost like a wash sale rule kind of in place. Yeah,
that's exactly right. So you get those, and then you got to hold for 5 years to get the benefits. We can talk about 1045 rollovers, but from the shareholder perspective, that's it. Original issuance, less than 50 million, hold for 5 years. From the company's perspective, and this is what I think what you were really asking about, is what does the company have to do? The company, it has to be a domestic C corporation, right? So S corporations don't get it. LLCs can get it, but only on conversion.
Okay.
Right? So domestic C corporation, and then the company needs to be a qualified traded business, right?
Which is so unspecific.
Yes, and that's the big gray area that keeps you employed, Christopher. Right?
Well, that's why I have a job. Exactly.
Yeah.
Right. So 1202E says for substantially all the taxpayer's holding period, 80% of the assets have to be used in a qualified trader business.
Okay.
Right. So again, that's also important from a shareholder, because, like, John can get his shares at some point, and I can get my shares later in the life cycle. And maybe there was a problem at the beginning, but for substantially all my holding period, the shares qualify, but for substantially all, his don't, right? So the point of that substantially all test is really, it's not like binary. QSBS isn't like we all get it or we all don't. You got to look really on an individual by individual.
It's like a timeline, literally, right?
Yeah,
and it's like at this point, it's funny. We were before we hopped on, we were talking about the CoreWeave IPO, and CoreWeave started in crypto and started as a crypto mining company, and now they're in software and data mining and data centers. So they're almost like the opposite. Like they wouldn't have qualified early on, but now obviously they have more than $50 million in assets.
Like, we have clients that start out really just selling insurance, and then they evolve into an insurtech company, right?
Interesting.
And so if I came in later, maybe for my whole 5 years, it was really a tech company, insurtech. But for the founder, maybe it's not, right? So anyway, this goes to the point. Like, so qualified trader business says the company has to be it has to be engaged in certain businesses, right? E3 says a qualified trader business is any business other than a business in the health, legal, accounting, financial services, banking, right? All like 20 categories, or any other trader business where the principal asset of the company is a skill or reputation of one or more of the employees.
So not a service business. Basically, like you got to be creating jobs that are not white collar, basically. Or at least to me, that's what it seems the intent is.
Right. Well, that's a super good question. And so does it mean if it's like a blue collar job? I think we can come back to that, right? That then it counts. But it seems clear, as you say, that like lawyers and doctors and bankers and stockbrokers are not supposed to get QSBS.
Yeah. Right. Because we could just start companies. I could just start Brooklyn FI 10 times over and say, I'm going to hire a bunch of advisors. And like, I'm not creating anything new necessarily. I'm just creating kind of like an enterprise of a bunch of different professionals.
Right. And then every 5 years you sell it off and start a new one and get that gain tax free.
Christopher, you're hired.
Exactly. Let's say I build an app, right? I build an app that says, if you put in this data, I will tell you if your shares are QSBS, right? And the app is, it uses AI to do all this stuff, right? To read all the articles I published a long time ago. They're all wrong with all the, right? And then does the analysis. That's not legal services, right? That's legal tech.
Yep.
Right? And so what we're worried about is like often, where are you on that line?
Yeah.
Gotcha.
Right?
So do you advise, do founders come to you and say, hey, I've got a business. Can you advise me on how to make it more QSBS eligible? Can you share kind of what tips and tricks founders can do, if they're really early, just to make sure that if they have flexibility that they do qualify?
Yeah. Well, I think a lot, the way we approach the kind of QSBS qualification, that is the qualified trader business, is like, what is the story, right? You got to be able to tell a story, right? The IRS, if you sell your company and it's whether it's QS, like, do you have a story that's consistent that makes sense, right? This is even like, did you start as an S corp and then reincorporate, do an F reorg? Were you an LLC? Like, do you have, the AICS number? What is that? AICIS?
Oh, NIAX or whatever.
NIAX
like that number that goes in the upper left-hand side of your Schedule C.
Exactly, right? On your 1120, right? Like, we see companies list themselves as like insurance, right? Or, like brokerage services, when in fact, they're really a technology company.
Yeah.
Yep.
Right?
And you want to steer them towards technology, right?
That's the goal. For sure. And I think a lot of people starting out in this, like this fintech or insurtech or medtech, whatever spaces, they see themselves like, are they really technology or are they really services, right? And that changes. 90% of the time when I end up talking on the phone with founders, though, I say like, tell me about the mousetrap that these guys are all out to build, and gals, right, are out to build a better mousetrap, right? So I'm saying, like, what did you build, right? And they see that they can disrupt in some way, right? What's going on, make these things easier. The first question I ask is, okay, tell me this. Did you live on ramen noodles and max out your credit card while you were trying to build this? If the answer to that is yes, it's QSBS.
Ooh, I love that. I love that.
That's it. Like, you guys sat around and coded and built this stuff, right? Everything else.
I didn't bill somebody hourly or collect commissions the whole time.
It's not like I was sending bills like a lawyer or a doctor or Brooklyn Pie. You guys are just, so that's it, right? I think when and you look at the IRS has issued a series of guidance. There's 11 pieces of administrative guidance that kind of lay out the IRS's approach. Now, there's some conflicting guidance there, but if you look at like the earliest, there's a 2014 private letter ruling involving a pharmaceutical company. It said this pharmaceutical company is in the health field. Health is one of the listed you can't be in health, right? But it said this pharmaceutical company, even though it's a health field, it's still a good qualified trader business because it's using its manufactured assets and IP to add value to its customers' lives. That's it. That's the most important language. Really, it occurs in a couple of later ones, but there it's like, hey, look, we built this technology, right, to make the pharmaceutical stuff better. There's a 23andMe PLR with the same idea, like they built this genetic testing stuff, or a med tech company that built software to, like for HIPAA compliance or whatever. Like, all those companies are qualified traders.
They're getting qualified because they got good advice early on.
Yeah, because they got good advice, and because they told. I think the issue is like the story they told was one where they were like, "Hey, look, we're really building something, even though we're putatively in one of these listed fields."
So I'm curious, Christopher, when you look at those founders that maybe didn't come to you right at corporate formation, or
Idiots.
folks that are, hey, somebody's coming,
No, smart. Right? Those guys are right. Hopefully they got good legal advice. Instead,
what are some of the misconceptions that business owners have that are calling you up? It's 7 years into the business. They were founders. There's a secondary transaction happening. There's a tender. They are taking some chips off the table, and they're like, I think it's this. And you're like, whoa, you don't understand these factors, or we should have done this differently. What happens in those conversations?
Yeah. Well, I mean, these guys are all super smart, right? These founders, when we deal with them, they're so smart. And all they really need is kind of like handholds to be like, hey, look, here's the rules. They'll go through. I love the founders because they'll they're like, I know how to code. The Internal Revenue Code just code. I'll just look it up and figure it out. Right? They're awesome, right?
I'm a coder. IRC, no problem.
Exactly. Right? They're self-help. They always just. I think the biggest problem that we find is that the founders don't know what they did in the past. Right? I say, hey, were you always a C-Corp? They're like, oh yeah, I was always a C-Corp. And then I say, well, send me the tax returns. And the first return is 1120S.
Mm-hmm.
Yeah.
Right? Their uncle in Ohio, who's a super nice guy, suggested
we charged him $12 to do the return.
Yeah. He did the return real cheap. It was a good deal.
Right. And at the right time, right, given where they were, maybe that's what they thought, right? But so I guess my first thought is like, make sure you go back and study the documents and see what you have. Because as I say, a lot of the time we end up, or they don't know the issue date, right? We talked about original issuance. right? You got to get shares. We'll have people say, yeah, I got the shares and then, so I'm at 5 years. And I'm like, well, send me your stock purchase agreement. And like, well, no, it's actually an option grant, but that counts, right? I'm like, no, dude.
Oh, didn't exercise. Yeah.
Oh, no.
Right.
Oh,
I think
no.
that's important. You actually have to own the shares. So the grant, unlike employees where the grant is usually enough to, claim those shares, as for QSBS, you actually have to take that extra step and exercise. You have to put some money down to actually receive the shares.
Exactly. Or do the 83B. So I guess, and I think that, Carta is doing a very good job now of doing those attestation letters. And we know the folks at Carta, they're great, right? But I guess I worry that sometimes people say, well, I got the attestation letter or the CPA said it's fine. And so, there's a lot of boxes to check.
Yeah.
Right? And I think it's important to go through and do that.
So what if you're a founder and you're an S corporation, you got those shares, it's year 2 of your company, you're going to be around for a lot longer, you're hoping for QSBS. What can you do to make sure that, okay, you made a few mistakes, wrong kind of, entity. What can that founder do now to make sure that going forward they qualify?
Right. It's no problem, right? It's like, this is, if you start, because as we say, you've got to get shares of a domestic C corporation. But let's say you make an S election, then you realize, oh, wait, we're actually going to be this great tech company. You can still get QSBS, right? That an S corporation can either drop down all the assets into a C corporation subsidiary, right, and take back shares. The S corp in that case would be like a holding company. It would just hold the shares. You'd start the 5-year clock, once you form the C corp, but you can solve for that. You can also actually do an F reorg where the S corporation ends up as a subsidiary of like a single member LLC, and then you have a C corporation sitting in between with a new S. So you can fix pretty much anything, right? When people come to me, they're like, hey, we're 2 years in, exactly as you said, right? And we're an LLC, we want to convert, or we're an S corp. I think you can pretty much solve all of those provided it's early on. It's the guys who get to 5 years and then they say, now I want to convert to a C corp, right? That's you're starting to run out of runway at that point.
Yeah.
And I'm curious, related to that, you'd mentioned you want to either be a C Corp or LLC and then convert. Talk a little bit about that, because I know for a lot of folks, starting up something that is a moonshot, that is they're taking a big risk. Setting up a C Corp, filing corporate tax return, doing all that stuff initially, issuing equity, it's like, damn, that's a ton of money I need to spend for corporate structure for something I don't know it's going to pay off. What do you see with the LLC conversion, that piece of it?
Okay, so I don't know, like, at least here in Silicon Valley, and I imagine in Brooklyn, like with all the hipsters where you guys, like, the single biggest cocktail party for founder discussion is LLC to C Corp, right? This is every single person thinks they're going to kill. So this goes back, and John, like this, remember we talked about, so at the very beginning we said, you can exclude the greater of 10 million or 10 times your basis, okay? So 1202I, that's in the statute, 1202I says that if you convert an LLC to a C Corp, or if you contribute assets into a C Corp, your basis is set at fair market value. Right, which is like you never get a step up in basis.
I was gonna say, it's just getting. So you
as
put
a death, right? As a death, you never get a step up.
Yeah.
Right. But so let's say John and I form an LLC.
Yeah.
And we start to build stuff. When that LLC is worth 40 million, we convert to a C Corp.
Yeah.
Right. Our basis for QSBS is set at 40 million. Right.
Wow.
So
even if you and I only put, let's say, $500,000 each into that.
We put in 500,000, and we've taken losses that whole time, right? So when we convert at 40 million, because the VCs come along and say, hey, we'll invest now if you guys convert to a C Corp at 40 million, that's our basis. That means we can each, and so let's assume we're 50-50, right?
Yeah.
20 million each. That means we can exclude the greater of 10 million or 10 times 20, 200 million each.
Oh my goodness.
Yeah. It's like,
that's a great deal.
It's like the golden ticket to do that.
It's crazy.
It's
crazy. And so can we just play that example out a little bit more? Because you also said that in terms of qualifying for a QSBS, that VC, your fair market value is 40 million, but the assets of the firm, let's say, are 3 million. Yep. So some VC or your next investors, you've still got $47 million of room there for someone to participate in that company being QSBS. So you have another $47 million of equity to grant to your employees. So you could potentially make a bunch of little millionaires out there. I love that.
Certainly, right? And now there's an open question. And again, this is why QSBS is so hard. Again, the hypothetical is that John and I convert at 40.
Mm-hmm. Yeah.
And the venture capitalists come in and put in 12 million of cash. Does that mean, for purposes of 50 million, I'm at 52? Right? 40 plus.
No, because it's valuation. It's not assets.
But the rule says, so 1202C says when you contribute assets or convert an LLC, the fair market value is the fair market value is no less than the basis, right? Like it's there, right? That you've created. Yeah. So, there's an open question about whether, in my hypothetical, we convert at 40 and then they put in 12. Do you just start over at 12 of cash? Because for all other purposes, you don't count that 40. Right?
Now, when would the clock start for the 5 years in that example, when we make the conversion from LLC to C-Corp?
Yeah, I think that this, now, there is an obscure argument that you can count LLC holding period, but I think you've got to be careful, right? Because now these companies grow so fast that, let's say John and I needed 18 months to get out of that $40 million pre-money value, now we've got another 5 years. Let's say we're going to sell in 3 years. We've got to worry about our 5 years.
Yeah. Wow. And so in that scenario, if we're going to sell in 3 years, maybe isn't that where a 1045
absolutely
might come into play?
Which is a whole nother set of rules. Right? 1202, we were just talking about 1202 with the exclusion, right? You hold for 5 years, so you can exclude the greater 10 or 10 million, 10 times your basis. 1045 is a deferral provision, right? So I'm a startup founder, right? And I sell my company at year 3.5 for $10 million, right? So I've got 18 months before I get out to my 5 years. I can go to John and say, hey, I want to invest in your startup. Within 60 days, if I invest in John's startup, I only have to hold those shares for another 18 months. Then I can sell and get out, right? Now, of course, giving $10 million to John, he's going to use that to buy beer pong tables or whatever.
Exactly.
Do, right?
Exactly. Since I was only born in 1992, so that's what I do on my weekends.
John doesn't know how to play beer pong.
I know too much about the Internal Revenue Code, Christopher, for you to want me to be your beer pong partner. Okay. That's the problem.
That's what I like. Anyway, but 1045 opens up a whole separate set of opportunities for people who don't get out to that 5 years. And I think in terms of questions, people forget about stuff, right? They get out to 3.5 years or 4 years and they sell and they're like, I didn't get there, because they're only thinking about 1202.
Right. Yeah. But, so you have 60 days to find another company to invest in.
You could 1045 into the acquiring company, right? You can just swap your shares for those potentially?
That's actually not 1045. That's 1202H4, right? So let's say which is similar but different, right? Like, let's say that Microsoft comes along and says, hey, Christopher, we're going to buy your company for $10 million. Okay, we're going to give you $5 million of cash and $5 million of Microsoft shares. Right? So if I get my $5 million of Microsoft, if I'm at 5 years, whatever, that's fine, right? I can exclude that $5 million.
Yeah.
But 1202H4 says the other $5 million of Microsoft shares that I got in exchange for my startup shares becomes QSBS up to that value, right? So if in a year from them I sell Microsoft for $6 million, the first $5 million of the Microsoft I can exclude. I got to pay tax on the delta, right? The appreciation, but I've totally de-risked.
Yeah.
Wild.
And in year 3, so let's say Microsoft comes along at year 3 and they're like, hey, Christopher, you want cash or just Microsoft shares? I should be like, I'll take only Microsoft shares. I get 10 million of Microsoft shares. I can ride out the 5-year clock inside of Microsoft and then sell, right? So that's cool. That's a huge, so for founders that are going to sell to strategics and need more time or want to de-risk, the 1202H4 gives a lot of options.
So as if 10 million and or more of completely tax-free money wasn't enough already, what if I'm a founder who's got a spouse and 2 kids and I want to expand my benefit? What are some sort of advanced strategies we can do here?
Yeah, well, this is where, this is what a lot of founders end up doing. This is QSBS stacking, right? So the rule says each taxpayer can exclude 10 million of each company, right? But 1202H says that if I gift shares to another taxpayer, that taxpayer steps into my shoes for holding period, original issuance, all the other requirements, the 50 million. So let's say I'm a founder and I'm going to sell my company for 30 million, right? If I do nothing, I can exclude tax on 10 million, but I got to pay tax on the $20 million delta, right? That's like 4.8 million that I'm going to owe to the feds, maybe to the state.
At least, yeah.
Right? But let's say instead that I set up trusts for my two little bratty kids, okay? And I transfer 10 million of shares into each of those trusts.
Yeah.
Right? Now we go into the transaction. My kids' trusts are on the cap table. So I've got 10 million. Each of the kids' trusts, we pay zero, right? Because they're separate taxpayers, each entitled to their own $10 million solution. Now, just like with the LLC, we didn't really get into it. Like I have a lot of reservations about that.
Sure.
With John and me going to 40 million, there's problems with employees. The same issue, that's a terrible idea, right? For people, I used to be like, give shares to your kids, do whatever you can to do the stacking. But often, I have to really if this is going to work, I got to give those shares away.
Right. It's not just we're not just moving money around. It's truly you've lost control, and the IRS will check in on that.
For sure, right? And so if I set up those trusts from the kids, it needs to benefit just them, right? I can't go back and be like, now, son, I want you to buy me a Maserati, right? This is, so in that hypothetical where we're going to exit for 30, I'm like, well, maybe do a trust for your kids for 2 each. In other words, I'm better off maybe with the post-tax cash in my pocket.
For sure.
Right? Rather than giving it all away.
Right. In the absolutes, it makes sense. The trust stacking makes sense. But in reality, we see this all the time. When you read about, TikToks full of nonsense influencers saying, here's how to exclude 30 million. It's like, well, you're not actually, the money's still leaving you. It's like, donate it to charity. I can save you 50% on taxes. Donate it to charity.
Exactly, right?
Okay, great. Cool bird sanctuary you got over there. I'll take my 5 million. Thank you very much.
We're going to get some emails about that comment. We got a lot of birders that listen to this.
Right, exactly. Right there. All the
I would love a bird sanctuary.
Yeah.
But you're giving up all that control. It's like you can give 20 million away to your kids, or you can give 4.8 million to Uncle Sam. What would you prefer? And in one scenario, you have 15 million more.
And so just pay the damn tax and move on. Yeah.
And
you already got 10 million.
Right. Better with post-tax money for you, right?
Yeah.
So that's in contrast, let's say I'm going to sell for 100 million, right? Then it definitely makes sense to at least do those 2 stacks for my kids, right?
Yeah.
And have some post-tax. You asked about spouses. There's an open question about whether husband and wife get 1 bucket of 10 or 2 buckets of 10. I think most people take the position that there's 1 bucket.
There's 1 bucket. Okay.
Right. So
you can divorce your spouse before the acquisition.
Well, that's it. Okay. So
separate buckets.
Right. So let me tell you just right. So
I'm listening.
Right. No. Okay. So here's what we know. 1202B3A says that if you're married and you file separately, each spouse only gets 5 million.
Got it.
Okay. 1202B3B says if you're married and you file jointly, the spouses have to split the exclusion in later years. But B3B doesn't say you're limited to 5 each. Okay.
Yeah.
Now, Shane would say, oh, no, you got to read those provisions consistently, right? There's no way Congress would give a double benefit, right, to married filing jointly versus married filing separately. But I think that there's a possibility that B3B, saying married filing jointly, opens up maybe you can do 2, right? Here's my hypothetical, right? So let's say that we have 2 founders, right? And they start out unmarried, right? She gets CS1 and he gets CS2. First 2 shares tickets. They start out, they roll, they're going along, they're building. 5 years into the enterprise, they get married. Okay.
Very unrealistic scenario that somebody's business partners for 5 years and says they want to marry them.
Exactly. So this
just
is
to be clear.
Right. This is
very unrealistic.
Never heard of
this. Right.
This is like that fairy smut I read. It's not real.
Then they sell. Right. Yeah. Those people were each, and it's what's interesting is the legislative history from 1993 says apply the exclusion on a shareholder by shareholder basis, not taxpayer, not filing status. Right. So they were each shareholders. They took on all the risk for all those 5 years. Then they sold. In fact, if they got divorced the day before, they would definitely get 20 million.
Yeah.
So I think it's an edge case, right? But I think in certain scenarios, if you have founders who start out together, there's a possibility. The trust stacking for kids or for parents or for siblings is much more straightforward.
Some interesting divorce planning to do here.
It's a very
John's single, by the way, ladies.
If you need to marry me to extract more QSBS and then divorce me and leave me with those shares, I'm okay with that.
You only take 25%, right?
At John TFO on Instagram, slide in my DMs. So just to kind of bring this all together, Christopher, obviously we've worked with folks who go through this transaction, that go through this sale. They're trying to exclude 10 million. You've helped folks with, opinion letters, basically insurance saying, hey, these are all the reasons why we think this qualifies in case the IRS comes back and questions it. But the more common scenario that we see, as much as I'd love to only talk to folks, have a lot of folks that are in that spot, the more common scenario we see is somebody starting something, they want to make sure that they're optimized for that. And so just thinking, as we kind of wrap things up here today, that startup founder is about to get a bunch of shares at par value, has some nice discretion about what they can do with them, transferring it to their spouse now, being mindful of gifting. What do you think the low-hanging fruit is? Should they throw some in trust for their kids at that low value? Not a huge percentage, not a huge dollar amount. Some stuff for maybe their parents, some other family member. Anything else they should be thinking about from their personal planning perspective, assuming they're going to get that QSBS at some point?
Well, I don't think so. I mean, my general advice is look, I'm happy to send gratuitous legal bill. I love sending a lot of big gratuitous, but the whole point of a startup is you don't know if it's going to work.
Yeah.
Right. And so does it really make sense to pay for a whole bunch of trusts when the shares are worth $1 and do that? Maybe if you got burned last time or you have pre-existing non-grantor trust, you could do that. But in general, my advice to the founders is just roll. Right. Once you raise your A round, then you know that it's probably worth it to do that planning. Right. But until, as I say, there's situations where a second or third time founder who already has a non-grantor trust, it's easy to do those transfers. But for the normal founders, my advice is don't over plan. Right. There's lots of ways to solve.
So 2 takeaways from today I heard were, if you ate ramen and used your own money to found your startup, your QSBS, and if you use someone else's money to pay the legal bills to determine if you're QSBS, you're in a good spot. Is that right?
That's it.
Okay, perfect. Christopher,
and a third reminder,
go ahead, John.
Don't, as lovely as your uncle in Toledo is, don't let him file your tax return if you're a founder with a unicorn that you're trying to build.
Go to Brooklyn 5. That's it.
There you go. Thanks, Christopher. You know so much about this. By the way, folks, if you are ever reading an article about QSBS that was not written by Christopher Hansen-Bridget, do not take it as truth. They are the true authority on this. We have worked with them directly in interactions with the IRS. They know their shit. So if this is something that's on the table for you, know the rules generally, but as Christopher said, get help when things start to look real, when you're looking at raising money. Thank you so much for listening. Thank you for coming on the show, Chris. Great to have you, John. You can email us your financial problems at liquidityevent@brooklynfi.com. Leave us a voicemail at memo.fm/liquidityevent. We'll play it on the air. And finally, Stans can leave us a review if they want to be weird about it. We'll see you next week. Thanks, folks. Bye.
Well, thanks, you guys.